Hey everyone, welcome back. I'm so excited today. We have with us Reine Ray, and I'm going to let her talk about, what she's doing. And this episode is called Secrets of an Underwriter. And I don't know if you're like me. I've been a real estate investor for going on 20 years now, and I've met two, and Renee's the second one. So this is the person that, when they tell you about your loan, well, it's in underwriting. Well, what does that mean? And so Renee is going to give it all today. She's going to talk about what is an underwriter, how they impact you, and how you can get prepared. So welcome, Renee. So happy to see you this morning. Just tell the folks, a little bit about yourself, your background. You have such great wisdom when it comes to mortgage lending.
You betcha. Thank you. Thank you so much, Nancy, for allowing me to be here today. I'm so excited. So a little bit about my background. I have been a mortgage originator, loan officer for 15 years since 2005. Oh my gosh, I guess I'm going on 17 years now where I've been licensed with the state of Texas. I've been a real estate investor since 2015. So I guess we're going into 7 years of that. In 2020, when COVID came roaring through, I decided I didn't feel comfortable being face-to-face with people. So I had an opportunity to take a job with a mortgage company as an underwriter. And I did all kinds of training and certifications with Mortgage Bankers Association and Knowledge Co-op. So I felt like I was prepared, but every day when I go to work, I'm like, oh my gosh, there's so much. So that's a little bit about my background. I live here in the Fort Worth area. I have 3 grown children. We just bought a second home in Colorado Springs, so we're looking forward to that road to retirement and figuring out how that works in our investment portfolio. So that's a little bit about me, Nancy.
Well, great. Now, what's the name of your company again? Tell everybody, because at the end, they might want to get in contact with you. So what's the name of your company?
So our LLC is Metrosun Properties.
Okay, great. And I know another conversation, we'll talk about Airbnbs, but today it's all about the underwriting. So just tell us, what is the underwriter? Like what are they doing when in the loan process? Where do you get into the underwriting? Like you fill out an application.
Right.
So tell us about that.
So let me take you through a typical transaction. So you get somebody goes out and starts shopping, right? So they're going to get pre-qualified probably with a mortgage company. The company I work for does it a little different. They let those underwriters look at it before they ever go out and start shopping. So that's a really solid pre-approval process. But what that looks like is a physical human being looking at income, assets, what credit looks like, mostly those kinds of things. The property comes, of course, later on. But mostly we're, as an underwriter, responsible for credit, income, assets. There's 4. I'll get to the second. Collateral is the 4th one. But for starting out, you're just verifying income and assets. So income for self-employed can be W-2s, K-1s, tax returns. Typically for W-2 employees, we have the ability to electronically verify that income. So sometimes you may not need pay stubs and W-2s. It might be with a company that's large enough to electronically verify that. We use online systems. Everything's pretty automated today through Fannie and Freddie. And they have online systems where it's kind of garbage in and garbage out. If you put stuff into a loan application and it's garbage, then you're going to get a false approval. And sometimes that's where that happens. You get somebody who is pre-approved up front and then a human being lays eyes on it and you're like, well, maybe they had a foreclosure, or maybe they had some credit, something that happened, or their income wasn't steady. That's the biggest thing we have to verify is the income steady? We do have some flexibility of whether or not we can, that the loan application is believable. It has to make sense.
Right.
So you got pre-application, and then a processor usually takes over and orders all the services, title, if a survey is needed, like it is here in the state of Texas. I'm trying to think what insurance. They're going to order those kind of services, so that by the time the underwriter gets it, hopefully all that stuff's in the file, and you just check and verify, and make it's the human touch. That's why I don't think the underwriting process will ever be automated completely 100%. Everybody's situation is different.
Well, I have a question because I know as when you're a real estate investor, it's a little bit, there's all different ways you can get money. And so you have to have like an investor loan, right? But what is I always call it the nebulous, when you think everything's approved, or when you work with buyers or whatever, and they're like, oh, it's gone back to underwriting. So is there a checklist that you all use? Why would it go, why would through the loan approval process, does it go back and forth into underwriting?
Well, right. I mean, I always, when as a loan originator, I was like, look, people are human. I want that underwriter looking at that loan file one time, because if they miss something, it's on them, right? So it's up to that loan officer who's putting that initial loan application together. And then the processor, it becomes their responsibility to make sure that that loan is intact by the time that underwriter looks at it. So they don't have to set conditions because they have a question. There's some loop that doesn't make sense. I had a situation where a loan officer and a processor had approved a loan. They got automated underwriting on it, but there was a derogatory in their credit on their mortgage. And so we have to prove that 12 months of payments have been made on time on a mortgage. If you don't have that, Fannie and Freddie, they're not going to buy the loan. So you're not going to get a loan if you've had a late payment. Actually, you can have two 30-day lates. But if you have two 30-day lates and a 60-day late, you're probably not going to get a mortgage. So they really want to put a roof over somebody's head.
Yeah.
And the repositories are the ones that affect that Fannie and Freddie unit. So when it goes back to underwriting, it's because somebody didn't put a full file together in the first place. But does a loan officer or a processor know the rules that you have to have 12 months of payment on time? Well, it depends on their training, right? So he had approved that guy, and that was a really sad case, because in this case, those people had sold their home and moved out and were living with family.
Oh no, I know these are the things. I know you've seen some things over the years. I mean, I think
you can't make this stuff up. It's crazy.
Especially when you're working with investors. Well, okay, we talked about that. I got my list here. Well, since you and I are both in a big real estate investment group, I wanted to kind of focus on what challenges do real estate investors have? They're typically W-2, maybe they have a spouse that's a W-9 or W-2. So how can real estate investors position themselves to get mortgages? Because I know that I've struggled in the past. I think you have to know the right type of lender to go to, right? Which we're going to get into.
We've talked about that a lot.
Yeah. But before I apply for a loan, so let's say I have a couple of rental properties now, and now I want to go and apply for a loan, and I have an LLC. But I bought one property in my personal name, and then one property I got a mortgage for it under my personal name, but it is in my LLC. So kind of just walk real estate investors through what you should do beforehand to get prepared so that the underwriter doesn't kick it out, right? And moving forward. So just go for it.
Okay, so I'm going to tackle that first one that you mentioned, that scenario where a borrower used their own credit, a real estate investor used their own credit to get a Fannie and Freddie mortgage. And you'll know if it's a Fannie or Freddie mortgage because it's in the promissory note. The promissory note and the deed of trust, they're the security instruments that drive how that house is titled and how the credit of that house was established. You've heard me say lots of times, Nancy, lenders don't mind taking the risk. They want to be compensated for the risk. And how are they compensated? Through rates and fees. So titling things in an LLC and using credit within your LLC, those are going to be, they don't mind taking the risk, but it's going to be at a higher interest rate. And as long as you can make it cash flow, what difference really does it make if it's a 3.25 interest rate or a 6.99 interest rate, as long as the bottom line numbers work? And when they're in your LLC, when the credit is in your LLC and the house is in your LLC, then your personal part is protected. Let me interject here. I'm not an attorney. I'm not a CPA.
Right. Not a financial advisor. We're just two gals that like to do real estate.
Talk about real estate, right on.
We work in the industry.
Check with your own CPA. But so that's that situation. If it's titled in your LLC, then none of that credit and none of that debt, the taxes, insurance, mortgage payment, HOA, none of that debt gets counted against you personally because it's the LLC that has the responsibility. Now, if you have a situation where maybe it was titled in your LLC, you found a lender that allowed that, and every lender's different. You may get turned down from one lender, but you may find another lender because it's all about risk and who's comfortable with that risk. It's always a good idea to have a mix of lenders. You may want a small bank, like you were talking, we were talking on the phone the other day, and you brought up that scenario, and I've always talked about this. You want that portfolio, you want several different places where you can get your money. And a small town bank where you're running rents through that bank, they're going to love you because you're bringing money into their account.
Yeah, and I'm just going to kind of interject there because that's called asset-based lending, to go to those community banks. And just to kind of what we're talking about, I use a bank that is local to where I live in Frisco, Texas, and they do everything in-house. You know what I mean? It all stays in-house. The decision makers are all in-house. And it still takes the, 25, 30 days to go through, but I've never once had them come back and go, oh, it's in underwriting, or, got to wait for the appraisal. So it's just because real estate investors cannot, once you start building your portfolio, you just can't go get, conventional mortgages. Like I'm, tapped out at that market. I can't do it. So one of the things I always try to teach people is you've got to ask the lender what type of, not just about the rate fees and all that, but what type of lending do they do? And, you and I have talked about the lenders that kind of say they're investor, friendly lenders, but in reality, this has happened to me multiple, until I knew what to ask, right? Where I'll apply for a loan because they said they were investor friendly, the rates were good. And then they're trying to put me into a conventional note. And I'm like, no, I will not qualify for that. You know what I mean?
You're not going to prove any income there.
Exactly.
Right?
And so then I just had my credit pulled and all that. So that's really important to kind of understand the process as a real estate investor. We'll talk about what I know you were telling me about a very interesting, and I know you have lots of them, the case study. So I have my properties, the mortgage and everything, the LLC. So, and I get K1s. So
so let's talk about that.
Yeah, let's talk about K1
study this week, because it was funny you called me, because I'm over here twiddling my hair going, people, I don't know that you can do this. So what happened in that particular case study, they were insurance salespeople. They had 4 or 5 different streams of income, and so you're going to see that on a tax return. You're going to see maybe an S corp where that's an 1120S where the K1s are. On the K1 in this particular situation, they had claimed like $63,000 in income, but they had no distributions. So they didn't, on the K1, it'll say, this is what you took out in box 1. And then I think it's box, I forget, maybe 17, but down on the bottom, it says, oh, I took out this. I had another one this week where they had 105 that they claimed, but they only took out 17,000 in distributions. Well, that's all the income you can give them is 17,000. So you got to check with your CPA and see what the repercussions of that. Now that's fine on that K1, but on this particular scenario, to take it to the next step, there's a Schedule L on that 1120S. And if that accountant would have gone so far as to say, I have 100,000 in January 1, 2020, and I had 100,000 at the end in December 2020, then we could have given them that income because they had assets to show it.
Okay.
But in this scenario, because the CPA didn't put anything to fill out that Schedule L on a set of 1120 tax returns, what's it cost to prepare those? I just think of shot those poor folks in the toes, So you just kind of got to watch. You got to know, you're paying a certified, licensed individual to prepare your taxes, but are they doing it in a way that helps you? You kind of give them control. I don't want to have to wrap my head around that, right? But those are some of the things you can check. Okay, I don't want to take the funds out of the company. I want to leave the funds in the company. I don't want to be taxed on that income. But if they'd have just shown what they had at the beginning of the year and the end of the year, we as underwriters could have given them that much money for income. But since they didn't.
Yeah, such a good point. I'm just going to throw out another disclaimer. Renee and I are not CPAs, tax advisors, financial planners, or anything like that. And if you didn't quite understand, like if you're kind of new and you didn't understand about, what's a K1 and should I have an S corp or LL, just discuss, and you should have a CPA, a real estate investor CPA, because again, if they don't understand what you're doing with your business, and you're investing and you plan to buy more properties, then, you could be caught in this scenario that Renee just talked about. So let's see. All right. So self-employed people, did we cover that? Like, how should they?
Well, let me talk a little bit more about that.
Yeah. Let's talk about that.
So in a situation, self-employed, a self-employed individual can choose to pay themselves on a W-2. Fannie and Freddie, they still say if they're W-2'd and they check that box on the loan application that they own more than 25% of the company, we still have to analyze their tax returns. If you have a borrower who might be W-2'd and the other person's self-employed, you can then just look at the W-2 income and ignore the self-employed if they're not using that income to qualify. So a lot of these different rules that I'm talking about, they're through automated underwriting. And so it's kind of garbage in, garbage out. Whatever you put in the loan application, that gets uploaded to the Fannie website and they read and analyze. I tell my loan officers often that they come to me and say, well, I used to be able to do it that way. I used to be able to. Well, remember that old line from Saturday Night Live, used to could? So that's the same situation. Fannie has a set of rules and it's artificial intelligence. It's AI. It's constantly learning. So it reads what's in the application and it'll spit out a set of findings. Now, some people try to get creative and say the findings say this, but I think I need this. That's where you get that situation of when somebody has to go back to underwriting because maybe the underwriter is pushing for more information than really what's required on those DU findings. Does that make sense?
Makes sense. Well, I kind of have a follow-up question about the underwriting process because, we're in the Dallas-Fort Worth area. The market is just crazy. People are paying tens of thousands. And I know of a couple cases where hundreds of thousands of dollars are being paid over list on properties. Same with investment properties. It's just crazy. If you're a seller, you have a house to sell and you have a place to go without having to buy something, you're sitting in the driver's seat. So appraisals, let's talk a little bit about that because
that's a whole other podcast.
When you go through the underwriting, so the loan officer pre-approved on, let's just say $300,000, right? So you're working with debt to income ratio and all of that based on that loan amount, $300,000. Now, this has not been happening, but I have read, on Facebook posts in our investor group where even though we're in this hot market, the appraisals aren't matching that at all. So then people have to come out of pocket, if they've got the cash to, pay those tens of thousands of dollars. But let's say they don't. Now it has to go back to underwriting, right? Because the loan going to get adjusted for the new appraisal?
Right.
So
good question.
Yeah.
Good
and I know
question.
that's another, but let's just kind of give the audience.
Yeah, we'll skim over the top of that.
Yeah.
So the loan happens based on loan amount or appraised value, whichever, or purchase price or appraised value, whichever is less. So let's use $100,000 because it's easy to do the math in our heads.
Thank you. That's for me.
So it's 100,000. The property comes in at 95,000. So you're 20% down or 25% down or 10% down or whatever comes off that 95, not the purchase price. So there's a lot of appraisal waivers. Have you seen that kind of thing happening in a contract? Or you have an appraisal waiver or you have a partial appraisal waiver where they'll say, we'll waive the appraisal and we'll pay up to $5,000 over appraised value or something like that. But that part becomes driven within the contract. Okay. So if you don't want to buy the house after it appraises $30,000 then less than what you offered it for, that language gets driven out of the contract.
Okay.
So there are different TREC forms, Texas Real Estate Commission forms that you can use to protect yourself to get out of that contract if you don't want to move forward, if you don't think the house is going to appraise.
And that is so common right now. So we were actually looking at purchasing a kind of a higher end Airbnb, and it was in an area, lake area, but not as competitive as it is here in the Dallas-Fort Worth area. And so I thought we had a good offer. We came in a little over, but as an investor, I'm not going to ever pay crazy dollars amount, right? It has to make financially sense. The numbers have to make sense. So anyway, our offer was good. We had a solid letter from the lender, that whole kind of thing. And the agent called me and said, oh, well, because it happened to be on the MLS. The agent called me and I represent myself as the broker and said, well, where's your appraisal waiver? And I'm like,
Right.
yeah, I'm not, so for me as an investor, I'm not going to go down that road, right? Because it makes no sense for me to pony up, 30, 40, $50,000 when, it's going to take years to recoup that, right? So for me,
Right.
and so I was on a podcast with like a private money, like he kind of raises money. And we were
Right.
talking about if you really are an investor, like now's a good time to, I mean, he had, I don't know, 100 properties and he sold them, paid the taxes because the tax is low for investors right now. Because and I have the kind of the same philosophy is that, sell high, buy low. I mean, eventually,
Right.
and we're going to get into this. I want to ask your opinion about, so, there's in the news and, interest rates are supposed to be going up. In your opinion, do you think interest rates will slow down the market at all?
No, because people need a house they need a roof over their head.
Mm-hmm. Because it's
You're
really
just
about
going to lose
inventory.
purchasing power. Yeah,
Yeah.
you're just going to lose purchasing power. Financing 300,000 at 3%, maybe your payment, let's just throw out a number, it's $1,200, principal and interest. Whereas 300,000 at 7%, now you're maybe at $1,500.
Mm-hmm.
So your principal and interest. So those aren't actual numbers. Those are just in my head to make a point.
Yes.
The interest rate is lower. So you're purchasing, you may be able to afford 350 as a sales price, 350,000 as a sales price. Whereas if the interest rates are higher, your purchasing power is not as high. So
Mm-hmm.
that's what buyers are going to lose is that ability to go out and purchase maybe something that they really couldn't afford back 5 years ago when rates were in their fives.
Right.
I think it's going to be a tender balance. I think that, when you look at the economy and what's happened in January and February with the price of things, just the silly little seltzer waters that we buy was $3.50 the middle of January. Today, they're at the store for $4.50.
Mm-hmm.
So that rate of inflation, I think that the federal government will try really hard to rein that in. I think another thing the federal government's going to do is really stomp on affordable housing. When Clinton came in, he changed a lot of those rules to make affordable housing. That's where those breather loans came from. If you could breathe, you got a loan.
Yep, I remember. I got one of those back in the day when I first started out.
Me too. I had stated income, but I proved my assets on the house where we raised the kids in Houston, and I had a 1.99 interest rate on that house for the majority of the time we owned it. So ARMs are good.
Here's dating back countrywide home loans, 90-10-10s. Remember those loans?
Yes. And real estate investor loans that were 80-20s. You could get one lien for 80% and a second. So that was during that Clinton administration. They wanted people in houses because that's where the gross national product grows. When somebody goes and buys a house, what do? They buy trash cans and rugs and garbage disposals, and they go out and spend money. You go to Lowe's or Home Depot or the big box stores, every weekend for the next 6 to 10 weekends. So people are spending money when people are buying houses. Mm-hmm. So I think it'll be a balance between getting that interest rate back up there and controlling inflation. So, the Fed says they're going to raise rates 4 to 7 times in 2022. The future will tell where that's really going to go. So it's purchasing power that people start to lose. So, if you think it's crazy now, I listened to a podcast yesterday where they were saying really what's going to be hot in the market is for real estate investors to go buy these houses that are just trashed, because that's going to be your affordable housing, and the government's going to help people to make those rent payments. So through Section 8 and those kind of things, you'll have guaranteed rent payments because of Section 8. And that was really the thing that they were focusing on in that particular podcast. That's really the money grab right now.
Well, and just to kind of go on to what you're saying, inventory is going to, there's still no inventory, but interesting you said that because, to tackle the homeless problem in most major cities, I just read where Dallas County purchased an apartment, kind of a rundown apartment complex, and they're turning it into It's actually going to be a halfway house for inmates, to kind of help them get back on their feet,
Right.
because they don't want them on the streets. And so you'll see more and more, I think
you'll see more and more of that.
Yeah. And I think too, like with COVID, I mean, a lot of people are not returning to work because I think employers see that they can be just as productive at home. So now looking at the commercial side, well, we're just speculating here, but there's a lot of empty buildings sitting around the area that I live in. And people are going to start saying, can we turn that into housing? Because there's just not, I mean, rents are out of control. And affordable housing is very hard to come by in the metropolitan cities. So,
right. And I think you'll see, as long as we have a Biden administration, I think you'll see more and more of that for sure. Yeah. That emphasis on affordable housing.
Well, we won't make this about politics today. So.
Right. Well, it is what it is. That is what they're focused on right now.
Mm-hmm.
We get lender letters that are released that, and you look at job openings and that kind of thing. There's a lot of staffing that's happening on that federal administrative end.
Mm-hmm. Well, good to know. So that's kind of a little tip, everybody, if you're listening. So. Well, yes. Hey, Renee, I just want to thank you so much for joining me today. This was very eye-opening about that elusive underwriter, and I'm so glad you shared. Do you have a great case study that you want to leave us with today that kind of sets the tone for everybody to pay attention to?
Well, I think it's all about what you can prove. It's income, assets, and that kind of thing, what you can prove. Money in the bank, cash is king when it's in your pocket. You can not have an approval and have no money in the bank, but you put 2 months of principal, interest, taxes, and insurance in the bank, and the artificial intelligence part of that loan process, part of that underwriting process, will pick that up and be more likely to approve that loan. You may think you want to put 20 or 25% down, but you may get a better interest rate at 10% down because you have a thing called mortgage insurance. Insurance protects somebody. In this regard, it protects the bank lending the money, that if that person doesn't pay, a portion of that loan is recoverable to that entity that's loaning money. So there's lots of ways to skin a cat. There's lots of lenders out there who do things different ways. So if you get one no, don't be discouraged by that. You take it to the next person and say, this is what I got. Work with a real estate investor-friendly CPA who knows how to set up those taxes so that you can gain income and still minimize your tax burden.
Great info, Renee. Thank you so much. We will have Renee's contact info below in the comments. Renee, I know you don't do loans anymore, so you're not really being able to do that. But if people just want to reach out and ask you a question, do you have an email address you want to share with everybody?
Yeah, sure. It's really simple. It's info at my company, metrosunproperties.com. Info at metrosunproperties.com.
All right. Well, thanks again for your time, Renee. Have a great weekend, and I'll be talking to you soon.
Thank you, Nancy. It was a pleasure.